Thank you very much, Stephen. Well, as you know by now, the Reserve Bank MPC hiking the repo rate. That's the rate at which the central bank loans money to commercial banks by 75 basis points. This brings the repo rate to 6.25%. A loan at the prime rate from your bank will carry an interest of 9.75%. This comes as inflation has been at new highs in the past 2 months. Khanyisa Phika is an economist with AlexForbes, and she joins us now to take stock of this decision. No surprises here, Khanyisa. What did you make of the comments by the Reserve Bank governor and the MPC, particularly when it comes to the importance, Khanyisa, of actually bringing back inflation to that target range of between 3% and 6%?
Hello, Xolani. Thank you for having me. I think the outcome of the decision was expected. We had priced in a 75% base point increase. I think because inflation had peaked at 7.8% in the previous month, it's slightly moderating yesterday to about 7.6%, still remains very high. Interesting is that the Reserve Bank had a split decision where 3 members wanted a 75 basis point increase, while the other 2 were advocating for 100 basis points increase. And I think that also talks to heightened inflation expectations, which the Reserve Bank is very cautious on their decision.
And one of the statements that Reserve Bank Governor Khanyisa actually made was that the failure to act timeously on the tightening cycle could have led or would have led later on to much more economic hardships or financial hardships for businesses and households. Do you hold the same view? It seems a lot of people are in support of what the MPC has done since the advent of COVID-19 in April 2020 here in South Africa, and the decisions that they've taken since then.
That's correct, Balani. I think the Reserve Bank has a strong resolve to maintaining inflation expectations within its midpoint target of 4.5%. And what they have done really is accommodate our economy more prudently and I think more effectively. They did also mention that the transmission would be supported by equally effective fiscal policy for maintaining or achieving lower debt levels, for example, ensuring that we do have energy that is conducive for the business environment and households. I think also the decision still remains, interest rates still remain favorable or accommodating for credit demand. What it is, yes, rising and at a time when households are pressured, but inflation is still quite high, which is even worse because it's throttling the disposable incomes. So I think this decision was in line with our expectations.
The MPC, Khanyisa, also expects that the inflation, headline inflation, will actually reach or moderate to 5.3% on average in 2023 next year. But that does suggest that there will be much more higher interest rate increases in the coming months, in the next meetings, because 2 of the 5 MPC members actually wanted 100 basis points.
I think what's important, Xolani, to also follow from the quarterly projection model is that it still forecasts a 6.75% terminal, which is expected at 2024. But what we think is that, yes, the SARB will continue to front load those interest rates so long as inflation remains elevated. They do see inflation moderating towards the midpoint towards within the broader target range in the second quarter of next year. We think that may be a little bit faster than that, perhaps in the first quarter, considering that global food inflation as well as international oil prices will also be coming down as that recession rhetoric continues.
And most importantly, the growth forecasted for this particular year revised downwards to 1.9%. No surprises there. And also further, when you look at 2023, 2024, this obviously does not bode well for unemployment creation in this country. Do you see it that way? Can we, at this present moment, looking at how the second quarter performed, expect that we would be thereabouts when it comes to 2022 at 1.9% GDP growth?
I think when we were recovering surprisingly well in the first quarter, it was welcome. And then we had the unfortunate scene of the KZN floods and severe load shedding. I think what will help our economy to recover more rapidly is if we can secure that energy supply and be supportive of economic activity. But yes, it will continue to slow down, considering that even our trading partners are slowing down in terms of their growth, and that doesn't bode well for our export as a country. So I think it's in line with expectations, and also a revision from 2% to 1.9% is not necessarily a big shift, but it is just showing that the economy will continue to struggle to generate those jobs if we do not invest in our energy supply and also other infrastructure reforms that will actually accelerate growth. I think we need an average growth of about 3% for us to see a sizable dent to our unemployment rate, which remains the highest in the world, even highest to the second highest unemployment rate. For example, Brazil has about an unemployment rate of about 15%, and we're double that. So it is quite concerning. And I think this is something that, yes, fiscal policy would need to accommodate and I think pair with monetary policy to be able to actually even see the effects of this monetary transmission.
The MPC, Khanyisa, also expects a 0.2% surplus when it comes to the current account. But when it comes to 2023, it's a different story. They are actually seeing a deficit in 2023. What does it say about the health of our economy looking ahead when it comes to what the MPC actually sees? You've touched on this a little bit. What exactly are we supposed to do as a country to avoid such scary data as a deficit when it comes to the trade that we do with other countries?
I think, well, we have had quite a surprising current account in the last 2 years, because we usually have a current account deficit, but we have had favorable terms of trade supported by the commodity price boom that we saw during COVID. But we do know that countries such as China that are still slowing down, and part of Europe also slowing down. Our trading partner growth is also moderating, meaning that their demand for our key export commodities will also reduce. And I think that talks to lower exports from our end, but also with the US dollar going to be much stronger and perhaps even for longer, we can expect that the rand will be quite volatile, and that will dent our pricing.
What do you say to what the MPC had to actually deliver they are actually expecting tourism and construction. They are forecasting growth on those two sectors in the near term. Tourism, it's understandable with the lockdown restrictions having been lifted, but construction has been struggling for years. Do you think that their forecasts are on the money when you look at how tough the conditions have been for the sector and the fact that the infrastructure spending has not actually been coming forth?
I think really we can expect a rebound, considering that those two sectors come from a very low base. So I think we can see and expect an improvement with the reforms that we saw, particularly for the travel industry, where we've had that visa regime come through. That should be supportive for international travelers to come into our country. In terms of construction, I think the growth there will be quite protracted, but there is activity, for example, particularly on the electricity side, where we're having those independent producers having to start with production side, that side. So I think we can see a little bit of movement progress, but it will be, I think, better than what we saw the dip in 2020, and because of that low base, we can expect just a gradual growth in those sectors.
So one of the interesting things that he singled out as well was the considerable risk that high headline inflation, the rise thereof, has on average salaries in South Africa. And he also spoke out about the high cost of living. Currently, when you look at how the average consumer in South Africa is doing, these interest rate hikes are not representing good news for the average man on the street because of the high cost of living.
I think, Xolani, the hike in rates, yes, talks to future curbing of future inflation. But what it does is, I think for the medium term, yes. For the near term, it is quite a constraint to households, but it will actually lower that inflation lower in the coming 18 months or so, and that should bode well for disposable incomes to be contained or sustained. But yes, we do come from quite an unfavorable environment where global food prices, global fuel prices have been quite higher than expected, and those are inflation components that households cannot, unfortunately, avoid, because the food basket makes much of their spend. But I think it is a tightening of the belt for the current environment, but also knowing that the future will look a little bit better in terms of our disposable income.
Khanyisa, that's all the time that we have this afternoon. Khanyisa is with AlexForbes, an economist there, saying tighten your belts right now because while the 75 basis point hike in interest rates by the Reserve Bank MPC is seen in a negative light, in the long run it is going to be a good one for your spending, as prices are expected to simmer. On